In 2022, one of the largest financial scams and Ponzi schemes in history collapsed. Unlike most other financial collapses in history, this wasn't created by a charismatic gentleman on Wall Street like Bernie Madoff. This scheme was created by an awkward nerd who liked to take meth with his girlfriend. If you weren't paying attention at the time, Sam Bankman-Fried, better known as SBF, and his crypto exchange FTX seemingly came out of nowhere, and immediately became one of the most popular crypto exchanges to use during the bull market that followed the 2020 COVID crash. FTX was getting celebrity endorsements from the likes of Tom Brady and Steph Curry in their ad runs, and was spending upwards of $20 million for Super Bowl ad time. You would be led to believe that at least on the surface, everything was running perfectly fine for the company. A young billionaire with the second largest crypto exchange in the world and his own private crypto trading fund called Alameda Research. Everything was running smoothly until it wasn't. In 2022, a string of events would lead to the unraveling of a multi-billion-dollar crypto exchange and cause the largest crypto crash to date in terms of value lost, resulting in over $150 billion being wiped from the market. But how did SBF rise to such a high position, not only in crypto but in finance, with him taking part in conferences alongside Bill Clinton and having entire financial media outlets idolizing him, just to have it all come crashing down in a matter of days? This is the story of SBF and the largest crypto crash in history. Now we have to go back in time to see just who Sam is, how he got his reputation, and what led to his eventual collapse. Sam's trading career began initially at the Jane Street Fund, a fund well known for hiring some of the brightest and highest performing maths and physics students in the US, and he would start working as a market maker trading global ETFs. After some time working as a market maker, Sam would start looking into other markets and assets and come across Bitcoin and cryptocurrencies, and he would notice a difference in the Bitcoin market between the US and markets in Japan and Korea, where Bitcoin was known to trade at what was called the kimchi premium, where Bitcoin was selling at a higher price in these countries compared to the US. A perfect arbitrage opportunity, where you could just buy on an exchange in the US, transfer it to the exchange in Korea to sell it and keep the difference for yourself. The only issue with this is the restrictions that would limit this practice, such as citizenship requirements in both countries to have a bank account and dealing with capital controls, and transferring money back and forth constantly between two countries on crypto exchanges is a good way to look like you're laundering money. Fortunately for Sam, he found someone on his college campus who was a Japanese citizen and was willing to open a local bank account for him to help. Now all Sam needed was the money to trade, which he got by managing to raise around $50 million from investors. Now whether you want to believe this story is up to you, as the kimchi premium in Bitcoin wasn't an unknown secret in the market that Sam just happened to figure out and exploit. And he definitely wasn't the only trader doing this at the time, as other people are known to have traded this basic arbitrage as well. But allegedly this is how he made his money, and the story people told about his origin that made him a so-called genius. Now when Sam was trading, he had only two real choices for exchanges: Coinbase or Binance. Coinbase is perhaps one of the most basic crypto exchanges you can use. It has the essentials and everything new people getting into the market would need, but for someone looking to trade with leverage or options, it doesn't have anything even close. Binance has many more of these options however, but Sam believed Binance to be less trustworthy due to relocating its headquarters regularly to operate around laws and jurisdictions. Ironic that Sam thought Binance was untrustworthy, especially considering how his own exchange would turn out. So with not much choice for Sam in where he could trade, he decided to set up his own exchange that he would call FTX. He would make sure to offer everything he could on his exchange, like options, derivatives, low fees, and high leverage. FTX would gain traction and popularity pretty quickly following its launch, as in 2020 it would process $30 billion in transactions every month, then $120 billion per month in early 2021, before processing around $1 trillion in the middle of that same year. But to continue building his empire, Sam needed access to more capital, so a meeting was arranged with Sequoia Capital, another famous investment fund, where he would be able to convince the partners of the fund to provide him with an additional $1 billion, putting FTX's valuation now at $18 billion in the middle of 2021, going on to eventually reach a peak valuation of $32 billion at the start of 2022. With these billions of dollars flowing through FTX and into Sam's pockets, Sam would splash out by purchasing a $30 million penthouse apartment in an exclusive community in the Bahamas. He'd even get big into his politics by regularly speaking to members of Congress regarding crypto matters, and would become the second largest donor to the Democrat Party. Sam's philosophy with his money was to be as generous with it as possible, to earn as much money as he could so that he can use it all to help others. and this was key to the persona he was trying to show to everyone. In 2022, when the Bitcoin and crypto markets would begin to roll over and crash, Sam would use his white knight persona of being a savior to help bail out some of the other players in the crypto industry, providing much needed funding to businesses on the brink of collapse, whilst preaching about being financially responsible in the crypto industry, and also warning that many crypto exchanges were already secretly insolvent and bankrupt. Another ironic statement for him to make, given what would happen just a few months later in that same year. Media outlets continue to eat all of this up as well, with Jim Cramer going so far as to label him and his company as the JP Morgan of crypto. In just 6 months after offering to bail out these failing crypto companies, however, Sam would announce that FTX was insolvent and was filing for Chapter 11 bankruptcy. Sam would later be arrested, and both FTX and his trading fund Alameda Research would be shut down. Now, Alameda Research is something that we haven't really mentioned so far, but almost certainly became the largest reason for the inevitable collapse of the SBF empire. In the lead up to the collapse, although most people believed everything was fine, there were a few people pointing out some of the sketchy practices being used by both FTX and Alameda Research in order to steal money from the FTX users and give it all to Sam. Back in February 2022, Alameda Research would lead a funding round into an unknown crypto token called Oxygen. It was so unknown that you couldn't research anything about any of the creators or founders of the token at all. Just 4 months after the token allegedly launched, it was already able to be purchased on FTX, which raised a few red flags for more experienced people in the industry. But that wouldn't stop Sam from promoting the token on his Twitter anyway. On the launch day of Oxygen trading on FTX, users traded $176 million worth of tokens. Anyone who would be unfortunate enough to hold their purchase from launch day would have lost everything when price dropped over 99% in the months that followed. It appeared to be a classic pump and dump scheme, created and ran by Sam, FTX, and Alameda. However, this wouldn't be the end of the trio's dodgy dealings, as they would also inflate the company's value and balance sheet with these same tokens. The way it would supposedly work goes something like this. Alameda would fund a project created by someone in the company, providing them with a few $1 million in capital. FTX would then list this newly funded token on their exchange, but only provide 1% of the token to the market for trading, meaning they still held the other 99%. Because there's so little of the token being traded, the price could be artificially inflated by FTX and Alameda, allowing them to trade it up and down to earn profit by manipulating it, whilst also being able to benefit from price increases as they held the rest of the tokens on their balance sheet. An initial investment that could cost them just a few $1 million could easily skyrocket to being worth hundreds of millions. Now, this was all on paper, of course, as these coins were worth next to nothing. But that didn't stop Sam and FTX from taking this one step further, as they would take loans out against these worthless coins to fund more of their trading and investments into riskier projects, along with FTX not backing customer deposits one-to-one, meaning FTX was taking customer funds and using them for their own investments. So if users wanted to all of a sudden withdraw everything they had on the exchange, like they did in November 2022, they wouldn't all be able to, as it just wasn't there. So how did all of this come to light? Well, the market starting to crash and taking down a lot of FTX's balance sheet and bringing their loans close to liquidation was just the start. But what really put the nail in the coffin was a man who Sam hated the most in the industry, Changpeng Zhao, or CZ, the owner of Binance. In 2022, CZ went to America to speak with regulators in an effort to work with them and the industry, something that Sam would take a small shot at by asking in a tweet if CZ is even allowed in DC, in reference to many of the legal troubles that Binance and CZ have had over the years. A few days after this tweet, there would be an article released by CoinDesk that would leak FTX's balance sheet, revealing to many people that it was indeed filled with scam tokens. Although it was also filled with some known legitimate projects, they were locked up on a timed release that they didn't have access to yet, including their own token FTT, which made up a lot of their holdings. So FTX's balance sheet was filled with a lot of unusable money, meaning if something went wrong, they couldn't do much about it. Almost everyone in the industry saw this article, including CZ, who would take the opportunity to fire back at Sam's tweet with a tweet of his own, where he would state that following the article revealing the company's finances, Binance had decided to liquidate any FTT on their books, so as to not be affected by what may come. Although CZ would tweet after that this was not a move against a competitor, it almost certainly looks like it was, as Binance held over $2 billion worth of FTT. Dumping all of that onto a market is going to collapse the price, and whoever's left holding it is going to be losing a lot of money. which in this case would be FTX, something that they just couldn't afford to do. This would lead to fear and speculation in the users of FTX, who would begin to rapidly withdraw their balances from the exchange, only for withdrawals to eventually be stopped by FTX as they just didn't have any customers' funds left after losing it all in their own trades. During all of this, Sam's girlfriend, who also ran Alameda Research, would tweet to CZ saying that if he would like to minimize impact on the market, then they would buy his FTT from him for $22 per token, not realizing that with that tweet she'd drawn a line in the sand, accidentally revealing FTX's liquidation price to everyone by not wanting the price to go below that. This would lead to another sharp drop in the price of FTT, and panic began to set into the market, with prices of all assets dropping even further. Eventually Binance and CZ would announce that they would step in to buy FTX after they'd asked for help, so they signed a non-binding agreement to do so and would be looking into the balance sheets entirely to see if it was worthwhile. However, just a few days after this announcement, CZ would tweet again stating that they would no longer be going through with the purchase, as the situation would be much worse than initially thought. Once again, the market collapsed as the situation just couldn't be recovered, leading to billions of dollars in losses and many FTX users being unable to retrieve any of the money they stored on the exchange. Sam Bankman-Fried and his girlfriend and CEO of Alameda Research, Caroline Ellison, would be arrested for fraud, along with other charges shortly after the collapse. The entire empire that Sam supposedly built was almost entirely a lie. His persona of being a white knight to the crypto community and wanting to save the world was all an act, just to get the respect and admiration he craved so much. The lesson of this story appears to be quite simple: don't piss off CZ.